It's the fear of missing out that's driving this.
Correct.
Right.
Correct.
Okay.
During that period.
Yeah.
And there were distributions happening.
Sure.
But yes, most of it was on paper in terms of the valuation uplift.
Yeah.
So what you then had was these managers raising at an incredible cadence, LPs not being able to say no, and particularly the US state pension plan market, which is the largest pool of capital to privates, going, well, we've got to sort of double down. But effectively, we're having to borrow allocation forward. So they're committing future years allocation.
So they're eating into 2023.
Exactly.
Right.
So what we saw in 21, and this was around October 21, and it was one specific US state pension we were speaking to at the time, they said, "Look, we think we're done for 22. And we sort of scratched our heads and said, well, hang on a second, you mean you're done for 21? It's October 21. No, we're done for 22. They had effectively pre-allocated all of their allocation to their respective managers, existing managers, to the end of 22. So over a year in advance. And that took everyone by surprise. It was, whoa, what's just happened here? Because no one had seen this. No one had seen this forward committing and the extent to which it was happening.
And it's not a technical thing. It's like a hype thing.
Yeah, completely.
I didn't realize this. Okay.
And so if you follow that through, and the same again happened in 22, where 23 was pretty much done back end of 22 as far as those managers were concerned,
right.
the LPs. What you then had is the correction. With that, the LPs had really maxed out to the best extent possible, predominantly into tech, their allocations to the private markets. You had this drop off in publics, massive denominator effect. The distribution started to fall, and it was the perfect storm. And this was all leading into 23. So 22 was a down year, still a pretty good year if you take it in the context of the last decade. But the first half of 23 actually was the epicenter. So, LPs really sitting on their hands, having committed to their existings, getting a new GP into your portfolio was almost impossible from an LP perspective. And again, I'm talking largely at the large end. And so just a very, very difficult time, incredibly difficult fundraising time, because if you're in our position, raising new capital into funds, established or new, first-time funds, it was now impossible. I mean, and we'll come to how we've managed to achieve what we've achieved, but it was very, very difficult. And in fact, we just completely put a line through first-time funds for some time, which has been reflected in the market stats as well.
Well, I have heard even very established kind of brand name mid-market managers been on the road for ages now. Yeah. And really surprised me, because it's like, okay, so maybe some of the big California state pension funds over-allocated and got caught up in the hype. But, we're talking about global capital pools. You think that really good, well-known managers that used to have a queue lining up, they're on the road. Is that your experience as well, that there are some really good names still waiting?
It's a big reset for the market, and it hasn't quite played out entirely. So the market, as you've heard, and everyone's heard many times before, invests by looking in the rearview mirror, as they say. So the performance of your 2017, 18, 19 funds is what's relevant today. What's happened in 2020, 21, 23 is largely irrelevant. That's money that's being put into the ground, but you've sort of got a stay of execution. It's really, what have you delivered prior? And everyone's up against this new benchmark, which is the performance that was generated through 2020, 2021, through these incredibly high periods of massive valuations. And there were significant distributions as well. So it wasn't all on paper. The VC market has had a very big correction, relatively speaking, not as big as the publics, but there hasn't been a significant adjustment on the buyout side in terms of valuations. So it's just a very challenging time for many, because whilst you've been very consistent and generated net 1.7, 1.8, 2, that doesn't really stack up to this new paradigm, the new benchmarks that have been created